Folks, I'm Peter, and I'm going to be talking about medical plans, but I'm going to go away from the screen for 30 seconds. So I will return. Yes, I'm back. Woo! I'm Peter Lemieux with the Insurance Exam Queen. We're going to talk about medical plans today. Welcome to class. Uh, Let me just see on the time. I'm going to delay a little bit so I don't start early. I know people with these live classes, people come in and go. It's like working a kiosk at a mall. You don't you don't have like people sitting down waiting to hear every word that flows from your mouth. So I'm going to spend some time trying to clarify the medical plans that show up on your test and how you can focus on the important areas in medical plans. Let me move my screen here and here. Thank you for your patience. I'm told that I don't look directly at the screen. Um, I am somewhat trainable with this stuff. So if you tell me stuff, I'll try to do that. I have in front of me a picture of me. Okay. That's fairly boring. I don't own a lot of mirrors for a reason, but the camera is above that. So I have to train myself to look above the TV screen I'm looking at so it looks like I'm looking at you. You guys know I'm not looking at you at all because I can't see you. Okay. Um, we're going to communicate by the chat box. Sunday, I'm awful sorry to hear that. Um, uh, Identify, please, not now, but identify those areas of weakness, and you want to focus on those and let us help you any way that we can. Certainly, if you've bought Melissa's programs, you want to review the videos of your weak areas. Okay. So I wanted to tell you that. I want to welcome everyone here. Um, and I'm not going to worry about who's here and who's not here. I am just going to start talking. To do that, I have set up a slideshow pretty much to keep me on track so I don't wander off and talk about stuff that's not helpful for long periods of time. And let me pull up the slideshow. Um, So you folks can see I've got a slide up there that says medical plans, the insurance exam queen. The only thing I would say is I'm not the insurance exam queen. I am a jester in her court. My name is Peter Lemieux. I have sold life and health insurance for over 50 years. Yes, I started when I was 2. And so it's been really a part of my life. As I told my family, you get to a stage where you're too old and too stupid to do anything else. So it's what you do. However, the last 15 years, I've really enjoyed helping people pass the state exam. It's in those efforts working for a national company that I met Melissa Dillon. And I knew that I had met somebody very special. She is an exciting personality. She's off the charts. She doesn't fit with typical insurance people. And that creativity makes her an exceptional teacher, dynamic, exceptional teacher. So when she started her business of the Insurance Exam Queen, I said, Melissa, if I can help you in any way, all you need to do is whistle, because I'm a big fan of Melissa Dillon. So I am here as a jester in the court of the Insurance Exam Queen. Now, with that as an introduction, a little bit of silliness and things like that, let me just advance the slides. And this, my friends, is a commercial. Okay? This is a commercial for me. If you go to YouTube to the Insurance Exam Queen, you will see two options: subscribe and join. If you click on join, I have made a class, a live class on every chapter in life and health. And we make all those videos. I think there's about 16 of them, some of them almost a couple hours long. So it's a lot of information from Peter. If you think you like the way I teach and it will be helpful to you, you can access all of those videos for $25 or $26. Okay, so it's an economically good choice. Again, if I'm boring you and you're not interested, don't bother, but I will tell you about that, and I think that's an option. Okay, let us continue on by talking. The first policy you're going to come up with in your studies is a basic medical policy. The basic, just think of it as ground floor, okay? It's the lowest level of coverage for the least amount of payment. It's a limited policy. It doesn't cover everything. It only covers certain items. For example, a limited policy would be a cancer policy. It pays nothing unless you get cancer. Okay? That's a limited policy. Because it's limited, these policies have a lower cost and a lower payout. So they're not going to pay all your medical bills. They'll tell you how much they'll pay, and that's all they'll pay. These are limited policies, okay? So that a basic medical policy works like that. Some of the items on the basic medical policy is there's first dollar coverage. That means, my friends, there's no deductible. From the beginning, the insurance company just starts paying the bill. They don't say you have to meet a deductible because there is no deductible on these policies. Well, that's fantastic. However, the next two tell you why they're low cost. They only cover certain up to a certain dollar amount, and rarely does it pay your whole bill. So it's a help, okay? It only covers certain perils like cancer only or something like that. Maybe only pay out in an accident. So they're limited, low payouts, but they pay first dollar. So people ask me, why the heck do you want sell this? Well, first of all, what we sell and don't sell is irrelevant to the test. It's on the test, so you got to know it. I only sell these policies as a supplement to the comprehensive medical policy where people may have a high deductible or something like that. Okay, but they do have a place. Most importantly, they're on the test. So you've got to learn. Those are some basics about the basic. Let's give you some examples of basic medical policies. Accidental death and dismemberment is not a life insurance policy. Why? Because life insurance policies pay when you die. This one only pays if you die a certain way. You got to die in an accident within 90 days of the accident. So there's a lot of deaths this policy won't pay out on. Now, when you study accidental death and dismemberment, you must know for the test these two items. What is the principal sum and what is the capital sum? The principal sum is how much is paid at the death benefit. The capital sum is how much as they pay out in a dismemberment, and it's less than the principal sum. So There's more to it than that. I'm just telling you folks, please learn that. Um, Dismemberment is the loss of a limb. If you lose 2 limbs, they will bump it up and pay the principal sum in the loss of 2 limbs. But know the difference between the principal sum and the capital sum. That does appear on the test. Now, here are some basic medical plans that could show up on your test. Dread disease. This policy only covers one disease. The most popular one sold today is a cancer policy. Now, you could get a policy that only covers diabetes or something like that. One disease is all it covers, one peril. Now, critical illness policy is still a limited policy, but they put more perils on it. So it's kind of like dread disease on steroids. I sell a critical illness policy that covers cancer, stroke, and heart attack. So if you get any of those, they'll make a payment. It costs a little more money than dread disease, but remember, it's limited. It won't pay for the knee that you blew out playing basketball. Okay. If it's not listed, they're not going to pay for your diabetes or your lupus or whatever. Only certain amounts. Picture a basic medical policy like a laser beam. It only covers this stuff. In hospital expense, they only pay you if you're admitted to the hospital. They don't pay in the emergency room. You have to be admitted and get a bed to get a payment from the insurance company if this is the policy you pay. And they only pay a certain amount of dollars per day, like 3 or 4,000 a day, which won't pay the whole bill. But it will help if you have a high deductible. Okay. Dental only covers dental, vision only covers vision. You can get plans that only cover prescriptions. And then our famous one I already told you about, which is the accidental death and dismemberment, are basic medical limited policies. Now, in the world of medical plans, the ones we love, the ones we want our clients to own, are major medical policies. They're wonderful for the last 2 items on the list. But to get this policy, you have to pay some of the bill. We call that cost sharing. You have to pay a deductible, which you must pay before the insurance company pays anything. And then after that, you still have to share the bill with co-insurance. I'll talk about that in a little more depth as I go. But the good thing about these policies is they're comprehensive. They cover all perils except exclusions. So when you read your exclusions, you may find that voluntary liposuction is not covered, or cosmetic surgery isn't covered. Experimental surgeries may not be covered. But if it's not excluded, it's covered. So we're talking about accidents and illnesses are all going to be covered unless they're that rare exception. So it's comprehensive. And they pay the big bills. Very, very high limits. So just to give you a war story, which we're not supposed to do, but 16 years ago, I had a heart attack. I was in intensive care for a couple days, and I left the hospital with a $200,000 bill, which today would probably be 400,000. I paid 2,000. My insurance paid 198,000. High limits. They're designed to pay the big bills. That's the way major medical works. Let's move on. Example of major medical: comprehensive coverage, high limit amounts, they'll pay the big bills, but you do have a deductible and co-insurance. I did not get the insurance company to pay my whole 200,000. I had to pay something. Okay. Now, examples of major medical that we have to know for the test are an HMO, a PPO, and a POS, point of service plan. We have to know these. This is a class on on medical plans. Know the basic medicals, and now we've got to learn HMO, PPO, and POS. We start off with the HMO plans. The HMO plans, there's a lot asked on HMO plans. Now, when I say a lot, maybe 4 or 5 questions. You're not going to get 40 questions on an HMO. But of this chapter, they like to ask about the HMOs. It's a prepaid medical service plan to specific medical providers, and they focus on preventative care. When you get a question about preventative care, please connect that with an HMO. Please do that. They want you to connect HMO with preventative care. In its infancy, what happened is these programs weren't started by insurance companies. They were started by doctors and hospitals who said, we are going to be an organization that's health maintenance organization, and we will treat you if you join our organization. So we would join an HMO by paying them monthly fees. And then if I go to those doctors and hospitals, I would get what they considered superior treatment at a reduced and lowered cost. But you join the organization. That's why we call it prepaid. That's what your payments do. But it's to the doctors and hospitals that are in the organization. And they really invented preventative care for free. It wasn't an item when they started. They were the first organization to say, come in and get your annual checkup. Preventative care is you have no symptoms, but you're of the age and stage where you ought to have something done to check you out, and we will do it for free. HMOs came up with that. That's why we connect HMOs to preventative care. Now, we want to talk about how they pay prepaid by using a word that's on the test called capitation. Now, for those of you who are scholars of foreign language, capita means head. Okay? Now, you can remember that if you ever heard of someone getting decapitated. Okay? Capita means head. So when we say we pay the doctors on a capitation or capitated basis, the insurance company, I should say the organization, right? The organization pays doctors for the number of people who've selected them as their primary care doctor. So I don't know if these numbers jive at all. We'll make the math simple. We'll pay you $20 a month for every person who selects you, whether they come to see you or not. So I get 100 people at $20. I think that comes to $2,000. I'm going to get $2,000 every month. And when those people come in, I'm not going to charge the insurance company because I have been prepaid. The numbers actually end up being much larger than that for doctors. But that's what capitation and prepaid means. They get paid whether they see you or not. So when you go to see them, they don't get paid anymore. The provider receives a flat amount each month, whether they see the patient or not. Now, it's service-based, not reimbursement. So, my friends, when you're getting to take the test, if you see the word reimbursement, that is not an HMO. Reimbursement is a PPO. Connect that, please. HMOs don't reimburse the doctors for what they do. They prepay you. We call it here service. The members have to choose a primary care physician, which is often called a gatekeeper. If you want to see a specialist, you have to get a referral, a specialist from your primary care doctor. And emergency care is covered whether you're in and out of the network. So I want to make this point. You have to go to doctors and hospitals in the network or you won't be covered. However, there's a huge exception here. If it's an emergency, you can go anywhere and be covered. So a trick question is, can people in an HMO be covered out of the network? And the answer is yes, if it's an emergency. Okay. HMO terms that we have to know. Primary care doctor is often called a gatekeeper. The physicians get paid on a capitated basis. Now, a big one is you must live in the service area to get the HMO. If you live outside of their service area, they won't insure you and you must go get another plan. I had a client once who wanted to buy an attractive HMO. He lived 1 mile outside the area. His doctor was in the covered area. His hospital was in the covered area. So we wrote for an exception and he got denied. For him to be covered, he had to show a residence inside the service area. So all three of these items you're looking at are very important to be covered by an HMO. Now, other things about an HMO, you've got to know the difference between an open peril and a closed peril. I just taught a P&C class. An open panel and a closed panel. An open panel says the physician can treat members of the HMO and non-members. So you can say, I have a PPO doc. Will you take me? If it's open panel, they'll say, yes, I'll just charge the P. With the HMO to be closed panel, they are telling the HMO they will only cover HMO members. So a closed panel restricts the doctors to only treating HMO patients. You got to know the difference between an HMO and a PPO. Now let's switch plan. We've got the basics of the PPO down. You people have been writing notes and you got that all clear. Let's talk about a PPO. For the purpose of your test, what they do is they define a PPO in comparison to the HMO. Where is it like an HMO and where is it different? So, different. It's reimbursement, not service. What we mean by that is your PPO doctor is getting paid nothing from your insurance company until they treat you. It's different in an HMO, right? Where they get paid every month. When you go to your PPO doctor, they treat you, submit a bill to the insurance company to be reimbursed. Reimbursement is a PPO payment plan, okay? They reimburse the doctor. However, the doctors and the hospitals don't need to join an organization. So they sign up independent hospitals and physicians, and they get paid a fee for service. They get paid for what they actually did. If they don't do anything, they don't get paid. So that's one area where we are different than an HMO. Because of that, you don't have to stay in the network. You can go to a doctor or a hospital that's not in the network and they will pay them. They just will pay them a smaller amount. It'll cost you more money to go out of network, but you will be covered. If you voluntarily go out of a network with the HMO, no coverage. The only time they'll cover you in an emergency. So let's just tell a story, right? My child has cancer. The type of cancer is best treated by the Cleveland Clinic. In an HMO, in the state you're in, if it's not Ohio, there's a good chance you're not going to have the Cleveland Clinic available to you. If you take your child to that clinic, you will pay the whole thing. However, if you had a PPO, you could go outside the network and still get payments to the Cleveland Clinic. You'll pay more out of your pocket, but you will be covered. Now, you don't need a referral from your primary care doctor, I should say. So if I want to go to a specialist and they're in the network, just go to them. You don't need your primary care doctor. If I want my shoulder operated on and I'm in an HMO, I can't go to an orthopedic surgeon. I got to go to my gatekeeper primary care who will then refer me. But if I have a PPO, I can just go directly to the specialist. And because of those reasons, usually PPOs have a larger list of doctors, HMO. So please be familiar with the fundamental differences between the two plans. And if you are, you probably will get almost all your HMO and PPO questions correct. If the ability to copy this slide with a screensaver or a photo, I highly suggest you do. It summarizes what I've just taught for the last 20 minutes, the difference between an HMO and a PPO. HMO, physicians on salary or prepaid, capita, right? Primary care refers to specialists, and they're known for preventative care. PPO, independent providers contract with the PPO. They only get paid if they treat you, fee for service. You don't need a referral to see a specialist, and you're covered in and out of network. Thanks for the slide, Peter. That's what you needed, okay? Now we've got our little hybrid plan called a point of service. Not really asked very much on the test, but just remember it's kind of a combo idea. It's a mix of an HMO and a PPO. Think of it as an HMO that allows you to be covered when you go out of the network. You know, it has all the features of an HMO. You got a primary care physician, you got to get referred to the doctor and things like that. But the difference is if you want to go to that person outside the network, you can and get reduced payments. So when I was taught about a POS, I went to the instructor and said, "Why isn't this just a PPO?" And their answer was, "Because it's not. It's an HMO with out of network coverage." So that's what I'm going to tell you, because it's not. It's a hybrid. Now, take a deep breath. I've been running through the jungle here. This is a word anybody selling insurance needs to understand, whether you're selling auto insurance, which has deductibles, homeowners insurance, which has deductibles, health insurance, which has deductibles. Life insurance usually does not. But a deductible says you, the insured, must pay the first dollar of the claim up to the meeting your deductible before the insurance company pays anything. So the amount the insured pays first before the insurance company pays out benefits. And it's always expressed as a flat dollar amount. Your deductible won't say 20%. It'll say 2,000, 200, 500. It'll be a fixed dollar amount to explain your deductible. But once you meet your deductible, that does not mean that everything is paid at 100%. It's not. After you meet a deductible, you now go into the co-insurance part of your policy. The most common co-insurance is 80-20. That means the insurance company pays 80%. They always pay the bigger number. But you, the insured, still has to pay 20% of the bill. So imagine I have a $1,000 deductible and a 20% coinsurance, and I get a $2,000 bill. I hope you can follow this. I pay the first 1,000 as my deductible. I then have to pay 20% of the next 1,000. So in that example, I will pay $1,200 to satisfy my deductible and coinsurance, and the insurance comes in with $800. But once I've met my deductible, for the rest of the year, I pay things on coinsurance where I pay 20%. You've got to understand deductible and coinsurance. And if that's not clear to you yet, please review our tapes to make sure you get that clear. Now, the question is, does that 20% go on forever? Obviously not. If you've been with me from the beginning of this class, I had a $200,000 bill that I only paid 2,000. 20% of 200,000 is 40 grand. I did not have to pay 20% of that bill. Why did that happen? All policies have a stop loss. Once the stop loss is met, the insured does not have to pay coinsurance for the rest of the year. My stop loss 16 years ago was quite small. I think I had a $500 deductible and $1,500 stop loss. So once I had paid the stop loss, the insurance company then paid 100%. It's kind of like, yes, I got to pay a deductible and I got to pay coinsurance, but that bleeding does not go on forever because of the clause we call stop loss. So here's an example. This is good to see an example rather than have to listen to me. The policy has a $2,500 deductible, 80/20 coinsurance, stop loss of 5,000. This is a typical test question, by the way. Okay. They tell you how the policy works, and then they tell you that there's a $50,000 bill. Now, before I go to the next slide, let's just think about this. Okay. I got to pay my deductible first, and then I have to pay 20%. But remember, my stop loss is 5,000. So let's look at the next slide. $50,000 bill, you pay 2,500. That leaves a bill of 47,500. You're supposed to pay 20% of that. However, you only pay 5,000. The stop loss stops your bills at $5,000. And to be clear on this, that stop loss pertains to the 20%. So actually, this client, if we're using stop loss, would have had to pay 2,500 plus 5,000, but never anything for the rest of the year. Now, I'm going to say something that may be a bit confusing. That's what teachers do. Stop loss, you pay the 2,500 plus the 5,000. That's what the stop loss is. However, stop loss literally stops the financial loss for the insured. Now, I don't know if this is worth teaching, but it is a technicality that's true. There's another phrase that we use today in lieu of stop loss. It's called maximum out of pocket. And you may see that in your study material as MOOP, MOOP. This is much easier to understand, and it's the most commonly used term. It's a little different than stop loss, accomplishes the same thing. Once the insured has met their MOOP, that includes the deductible, coinsurance, and co-pays. Everything in the future is covered at 100%. So once I meet my maximum out of pocket, I don't have any expenses for the rest of the year. I don't make co-pays when I go to the doctor. I don't make any payments on my prescriptions. I don't make any payments in the hospital. So MOOP is actually a legal statement that that's the maximum you can pay in a year. Importance about MOOP. When you can show that to your client, you can say in a worst case scenario, the most it can cover you, the most it can cost you in a year is this $5, $6, $7,000. You'll never pay more of that. Very important for those of you that are sticking around. That MOOP only applies to covered medical bills. So, for example, I got a 6,000 MOOP, and it's a bad year for me. I'm in a hospital, I'm in intensive care, and I pay out $6,000 on deductibles, co-pays, co-insurance. Now I don't pay anything for the rest of the year, right? Well, yes, if it's covered by the policy. If you find out that you need bridge work on your teeth, you're going to pay for that because it's not covered on your medical policy. As long as it's covered on the medical policy, maximum out of pocket limits what you can pay out in a year. So before I go to this slide, let me just remind you what this will help you understand what the insurance company pays and what you pay. Deductible first, then 20% or 30%, whatever your co-insurance is, up to the stop loss. However, if you have a policy with a MOOP, you add in deductible and 20% and copays. And once you've met the MOOP, you don't ever have a payment on covered expenses for the rest of the year. Now I'm changing topic. These are terms you will see on the test that you need to be clear on. Some insurance companies pay by a benefit schedule. In other words, they will say, this is what we pay for this procedure, and that's all they're going to pay. We actually see these plans, and this isn't on the test, in rural areas of our country, where the insurance companies say, we will pay any doctor, any hospital, but only up to our schedule. The benefit schedule is set in writing, and that's what the insurance company will pay. However, there's another type of benefit schedule, which we call UCR, usual, customary, and reasonable, where a schedule is set, but they have different schedules for different parts of the state. Benefit schedule is set for the whole state. But we know some areas of the state are more expensive than others. So some companies use usual and customary and reasonable, where they'll pay more in the more expensive areas. The reason you will get all of those questions right is by looking at the last 3 words on this slide. UCR is assigned to a specific geographical area, and that's the words they use. Okay, so it might be by zip codes, it might be by counties, but it's a specific geographical area. They have a different schedule in each area. That's usual, customary, and reasonable. Benefit schedule is same no matter where you live in the state. So an insurance company could pick one or the other in making their payments on these policies. Okay. You know, America, I do see your question, your statement on the chat box. When I finish with, if you can stick around, if you want to ask me some questions on the chat outside of what I'm saying now, I'll be happy to see if I can help you, kind of sticking around after class. But hopefully what I'm doing now is helping clarify some areas. Let's talk about, oh, it's time for a commercial. So we have some dancing hot dogs singing to you, and it says, if you go on YouTube for the Insurance Exam Queen, click on Joint, you can get Peter explaining in much more detail every chapter you study for life and health for $25. So that's my commercial. I'm sticking to it, and that's how you do it. Back to the class. Utilization management. Here's 3 terms that on the test: prospective, concurrent, and retrospective review. It's probably worth a point, maybe 2 on your test. Easy to learn. So if you know it's going to be on the test and you get it wrong, you only can you're to blame. You didn't study something we told you was going to be on the test. A prospective review is reviewing the claim before you ever get treated. So that would be like getting pre-authorization to do a surgery. They check with the hospital, the doctor, the insurance company, and it gets pre-approved. That's done all the time. Prospective review. Concurrent review is a review during treatment. Now, the example they use, I'm not real good at explaining it because, anyway, I'm not going to tell you why. They consider a second opinion a concurrent review. So we're looking at the surgery and we want a second opinion. The insurance test considers that a concurrent review as we're doing the procedure. But anyways, that's what they say. A retrospective review is done after you've been treated to say, did it work? Okay. What was the results of this? So the insurance can review you prospectively before, concurrent second opinion, or retrospective after. This will be on the test a really easy point or two for you. You just got to sit down and learn it, right? Networks. When you buy an HMO or a PPO or a POS, there's a network of doctors who've agreed to accept that insurance. Okay? What we find out is a narrow network has fewer doctors and fewer hospitals, and they don't charge you as much. The insurance companies, and I think the reason is they don't pay as much to the providers, so they don't get as many providers, but they can take that cost savings and charge you a lower price. Oftentimes, the lowest priced plans have very limited numbers of doctors and hospitals that you can go to. We call that a narrow network. If it's a broad network, you have more providers, then that's going to cost you more. Now, there are insurance companies who offer both on the same plan. Large health carriers will say we have plan A, which is our lowest cost plans, but it's got a narrow network. Okay. Same benefits, same deductible, things like that. There's fewer doctors you can use. Okay. A broad network plan is lots of doctors, lots of hospitals at a higher price. That shouldn't be hard to remember if we get it on the test. Now, these are going to be on the test. Those of you that have stuck with me or just joined, please make sure you have a sheet of paper that explains to you the difference between an HSA, health savings account, and an FSA, flexible savings account. It is on your test. So excuse me, I'll wet my whistle with a little bit more hot tea. Oh, it's now cold tea. What is a health savings account? A health savings account is a checking account. It's a special checking account that the IRS has blessed and says if you open this account, any money you put into that account, you will not pay taxes on. You can deduct it from your taxes, or you can have it taken out of your pay untaxed and put into the account. It's a special account. However, you cannot open this account unless you have, for your insurance, an HDHP. Now, aren't we smart when we can talk to each other in letters? Big whoop. It's a high deductible health plan. It's a specially designed plan that allows you to open a health savings account. Insurance companies often call them health savings account plans, but the account is actually at the bank. The insurance company sells this high deductible plan. And the way it works is you buy a plan with a high deductible, but you must meet your deductible before they pay anything, which means in common sense English, I cannot go to the doctor for $10 or $15. I'm going to pay the whole bill until my deductible gets met. When I go to get a prescription, I can't get it for $15 or $20. I will pay the whole prescription until my deductible is met. Once I meet my deductible, then the insurance company comes in. But because I bought this plan, I am allowed to put money in a checking account untaxed and pay my medical bills without ever paying tax on the money. Tax deductible contributions into the HSA account. Funds can be used to pay medical bills absolutely tax free. Let's see what the next slide does because there's more to this. If you happen to use that money for non-medical expenses, so you decide that you want to use that money to buy tires on your car, bad move, because as soon as you take the money out, it's subject to income tax. Plus, you're sitting down with your seatbelt on, a 20% penalty. My friends, if you pay 20% income tax, You take $1,000 out of that account to buy tires, you're getting $600 because of the penalties. Those will end up being very, very expensive tires. So you want to make sure you only use this account to pay medical bills. However, the really good news about a health savings account, if you don't use all your money up in a year, it doesn't matter because that just move into the next year and that account is always yours. You can pay it, use it to pay future medical bills. So if in the next year I change jobs and I don't get an HDHP offered to me, I can't put any more money into the account, but I can still use that account to cover my deductibles and things that aren't covered. So that money moves forward to me as long as I'm not taking it out to pay non medical expenses. Now, exception, and this is on the test, once you hit age 65, you can use your health savings account and only pay the taxes, not the penalty. So, in a sense, it can become like an alternate IRA because in an IRA, when I take the money out, I have to pay taxes. So, if I have a large amount in my health savings account, I can, of course, take it out to pay medical bills with no taxes. But if I just want to take a trip, I can take it out by paying the income tax only if I'm over age 65. So, my friends, that's all you needed to know about a health savings account. That's what's on the test. Okay. But then we have to learn about the other one, a flexible savings account. Some similarities and some extreme differences. The flexible savings account is nothing you can set up. I can go out on my own and buy an individual HDHP and set up my own health savings account. Or I can get an HDHP by my employer and go and get the account. The flexible savings account is set up by the employer, not you. So you either get it offered to you or you don't. The employer will let you know we have available an FSA if you want it. The employer will tell you the maximum you can put into the account. Let me back up the truck. What's the maximum amount I can put into an HSA? That's set every year by the IRS. But in a flexible savings account, it's set by the employer. So they can say you can't put in more than $1,000 or $2,000, whatever. And then if you want it, what happens is you have the money taken from your paycheck tax free, gets put into an untaxed account where you can pay your medical bills. Oh, that sounds like an HSA, doesn't it? Yes. There is a medical flexible savings account and there's a child care flexible savings account where you can put the money in the account and pay your child care. So it offers you some different alternatives. Big difference between the two. It's use it or lose it. And what I mean by that is on December 31st, if you have money in your FSA, it's gone. It's your money that now goes into the pocket of your employer. You must spend it in the calendar year. It doesn't move into the next year like an HSA does. So there are some similarities and there are definitely some differences between an FSA and an HSA. They're both on your test. So my recommendation is take a sheet of paper, draw a line down the middle, HSA on one side, FSA on the other, and list these items and learn them so you can get all of correct on your test. So here's a slide which you can copy and tells you the differences. HSA carries over, FSA does not. HSA can be set by an employer or you can buy it on your own. The FSA must be set up by the employer. FSA allows child care payments. HSA does not. HSA is limited by the government, how much you can put in. FSA, the limits are set by the employer. And folks, that's a really, really good slide to help you know the differences between the two. And you can go into the test with confidence. When that shows up, it will show up. Some fundamentals of group insurance. Know the difference between contributory and non-contributory. In a contributory plan, the employees pay some of the plan. Non-contributory, the boss pays everything. Now, there's a participation requirement on these plans. If I'm an employer that says I want to provide medical coverage for my employees, but they're going to have to pay some of the bill, 75% of those people eligible for the plan have to join the plan. Now, who's not eligible? Maybe part-timers, maybe people who haven't worked there long enough, maybe seasonal people. But of the people who are eligible, 75% must join the plan because the insurance company does not want a plan where only sick people join it. When I first started selling group insurance, I met that employer. He and his wife had cancer and they wanted to offer a plan, but they had to offer it to the employees. So what they did was pick an expensive plan that they knew the employees couldn't afford. And the only two people that were going to sign up were the employer and his wife. They were not going to get approved. They didn't meet participation requirement. They would have left the insurance company with just the sick people. Okay. That's 75% on contributory plans. If I, as an employer, say I'll pay the whole thing, everybody comes on the plan because it's free. You just get it. The employer's paying the whole bill. So know the difference between contributory, non-contributory, and what's the participation rate in both. Um, Also, a simple question that, praise the Lord, is on every test. There's only one policy in group insurance. It's called a master policy, and the sponsor, the employer, gets that one policy. The insureds don't get policies, they get certificates. Very, very easy to learn that. It's on your test. You start off with a grade of 1 by learning that information. Who can buy group insurance? We list 3 entities. Employer sponsored is who we talk about all the time because that's who we sell to, but also association, Mets, and MUAs. And so let's walk in that park for a second, okay? Employer sponsored, the employer offers it for the benefit of the employees. The insurance company has group underwriting, misspelled underwriting. That means you'll see group underwriting on the test. No health questions are asked of the employees. If you work there and you're eligible, you're on the plan, regardless of how sick you may be. The insurance company works on the law of large numbers. When we get a group, we'll get some healthy, some sick. We got enough numbers to take care of it. No health questions, okay? Remember, there's a participation level, whether it's going to be contributory or non-contributory. And if a group has more than 20 employees, they make COBRA available to terminated employees. So that's an employer-sponsored plan. When an employee leaves the company, they have 2 choices to continue insurance: conversion and COBRA. The most common and the one on the test the most is COBRA, but let's just quickly get rid of conversion. In conversion, you can take your group policy, change it to an individual policy with the same insurance company if you do it within 31 days. Now, people don't usually do that, but there's some advantages. Number one is when it's your policy, you can keep it for as long as you want. COBRA only lasts for a certain amount of time. Bad side of conversion, it's a brand new plan, so your deductible starts over again. If you stay on COBRA, look at the days. You now have 60 days to join it. You get to stay on the same identical plan, which means if you've used some of your deductible, you get credit for that. Okay? You just stay on the same plan and you pay the premium of the plan without help from your employer. limited by the fact that you can only stay on COBRA for 18 months. So you can continue insurance by choosing one of those two options. That covers employer-sponsored part. Associations, these are the three things an association needs to qualify to buy group insurance. If you're in Arizona, association needs to only have 25 people in the association. Everybody else needs to have 100. Association has to be active for 2 years and hold annual meetings. What are we talking about? Yeah, like an HOA, members of an HOA. The HOA could offer insurance if they meet these requirements. And the last ones, not as commonly asked, okay, are multiple employer trust. Multiple employer trust, please picture this. Employers of the same industry. You see how I've got similar industries there? Let's make up air conditioning companies. They write a trust called the Air Conditioning Trust. That trust can buy a group plan that would cover all the companies who participate in the trust. That's perfectly legal. It's called a multiple employer trust. They have to be in a similar industry. They have to have a trust because it's the trust that buys the plan. And they have to be a member of the trust. The trust purchases the insurance. So that's certainly legal. It's a MET. MUA is a little bit less commonly asked. You only need 2 people to offer a MUA. And the problem with a MUA is usually the employer who's offering it self-insures it. State insurance departments are very uncomfortable with this. What if that employer doesn't have enough money to pay a big claim? So insurance departments are not crazy about these things. I once got a letter in my state told me I'm not allowed to sell them or they'll take my license away, but they are legal and they exist. And the problem with it is the employer, instead of paying an insurance company, takes the money they would pay an insurance company and keeps it to pay the bills of their employees, which means the employer is taking on the risk of big claims. And they may or may not have enough reserves to do it. So you've got METs, multiple employer trust, MUAs, multiple employer welfare association. You've got associations like an HOA, and you've got employer sponsored. Those are the 4 types of groups that can get insurance. Now we're going to close out our intimate time together. Hasn't this been fun? I'm not being sarcastic, please. The Affordable Care Act. When I first started teaching, I was so ready for this. I had a 45-minute presentation on the details of the Affordable Care Act. And after a short time, I got told I'm wasting my time because there's only 2 or 3 questions on the test about the Affordable Care Act. So I've whittled it down to a couple slides of what you need to know. This was a law passed in 2010, active in 2014. That's when it became active for the country. Affordable Care Act does not offer insurance policies. It's a law that says if you're going to offer an Affordable Care Act approved plan, you have to follow some rules. Rule number 1, you cannot decline anyone. If they apply for it, they get it. All pre-existing conditions must be covered. Children can stay on the parents' plan until they're 26, even if those children are married. You can't cover the children's spouses or the children's children, but the child themselves can stay on the parents' plan. This is a big one to an insurance professional. No limit on coverage. For the essential benefits of an insurance plan, there is no amount of insurance where they stop paying. Used to be before this law, your policies might cover you for $1 million or $2 million. And if you became like a paraplegic, you could run out of insurance pretty quickly. And then, because there was no Affordable Care Act, no insurance company would take you, and you didn't have any coverage. So you'd have to go on welfare, or you didn't have any coverage. This part of the law stopped that. That means that if you have a condition that's going to cost you a lot of money every year, wheelchairs, medicines, physical therapy, you don't have to worry about running out of insurance. The insurance company cannot stop paying you. There's no limit. Okay. And the Affordable Care Act requires every company selling an approved Affordable Care Act plan to cover 10 essential benefits. Another piece of good news, my friends, there are 10 essential benefits, and that's a question. We will remember it because there are 10 fingers on Peter's hands today. 10 essential benefits. They don't ask you to memorize them. They want you to know that you know there are 10, okay? Furthermore, who can get this? If you are a US citizen or legally in the country, you can give it. You can't give it if you don't live in the country. So I had an American who lives in France. They want to know if they could buy Affordable Care Act plan. I'm sorry, they can't. It doesn't work well in foreign countries. You can't be in prison. Actually, prisons cover their own um, uh, prisoners, and you can't be on Medicare. Okay, if you're on Medicare, you're already covered by the government. But the Affordable Care Act is available to those people. Sometimes we get a question about who can and can't plan. Um, we sell Affordable Care Act plans in metals, METAL. If you buy a bronze plan, 60% of the bills are covered, silver 70, gold 80, platinum 90. I want to talk about the percentages. That's not co-insurance, and it's not as simple as whatever the bill is, you will pay 40%. There's a complicated formula that the insurance companies complete, and they fill that out and give it to the government. The government assesses whether this is a 90, 60, 70% plan. I wouldn't worry too much about the percentages. Just know that there are 4 metals, platinum being the best plan, most expensive, bronze being the least expensive, and the least covered. But they all cover everything I told you. All pre-existing conditions, no limits on amount of insurance you have, children till 26, all of them are covered that way. Okay. Um, Affordable Care Act has 10 essential benefits. 2 that were new when they passed the law were maternity and mental health. I used to be able to sell policies, and people who were 50 years old or men didn't get charged for maternity. People who could say, I don't want mental health, I don't want to pay for it. You don't have that choice anymore. Everyone, including, yes, men, everybody pays a maternity premium and mental health premium. You're going to have it covered whether you can use it or not. It's required as part of the 10 essential benefits. Now, there are 2 other plans that I'm not covering today. They are a chapter onto themselves. Disability income, very important. I'm going to actually be teaching that in a live class soon. And long-term care, um, cover your nursing homes. I actually put these 2 together in a class. I don't remember my schedule, but it's sometime, I believe, this week, maybe even tomorrow. I don't know. But just look on the schedule. I'll be teaching those 2 products in that class. And finally, if you want to look at all the chapters, if you think my teaching is helpful, you can access all chapters, life and health, for $25. It's a subscription, $25 a month. Stop it when you pass the exam. I think it's a great deal. So that's my story. I am sticking to it for the time being. Closing remarks from Melissa, please remember, stay calm, study the materials, don't memorize questions. Use all of our tools. There's a plethora, there's a big word, a lot of stuff that we offer to people to get you through this test. Just review something every day. Let us help you that you will pass the test. Okay, let's see. What did I get? Carol, I never caught a live of yours, but thank you. And Melissa for helping me pass my test on P&C. And last, life and health last night. Your class is the best. So, Carol, I'll send you your pre-packaged hot dog for helping me out. But anyways, yes, thank you very much, Carol, for the praise. We hear that. I'm not discrediting you, Carol, in any way, but we do hear every day from people how helpful the Insurance Exam Queen and our methods are. So I want to thank you folks for attending. I've had a good time. I hope you have learned some things. Take a look on Insurance Exam Queen for other live classes. They're free. You can come in and join them, and I got a couple more coming up this week for sure. So I'm going to say that's it for me, with this exception. If there's someone here like America or Sunday or something that has a question that about medical plans or not that they're unclear on, I can take a few minutes and try to help you. Just put the question in the chat box. For the rest of you who are leaving, thanks for attending. Look for us. Let us help you in the future, okay? Any questions on the chat box for me? Uncomfortable silence. That being the case, thank you very much for attending. Look to the Insurance Exam Queen to help you get through your test. I do one-on-one mentorings, Melissa. They're not free. Okay, I will tell you that. I do charge for that. I give an hour at a time. If you have any interest in that, what you need to do is inquire from the Insurance Exam Queen, or I will put my personal email on here if you want to copy it and write to me. I will write back and tell you how it works and how we do it. We can do an hour at a time. I tape our one-on-one and send you a copy of it afterwards so you can review it. But let me just do this. So there's my email address should you want to copy and paste that. Thank you all for coming. It was a pleasure. Enjoy your day. Stay healthy. Study every day. Let's get through this thing, okay? I am back. I think I look at the schedule. I don't have it in front of me right now. I think I'm teaching again tomorrow, but I try to teach several times every week live, and then you can access my tapes by doing what I said about going to the YouTube and clicking join. So good afternoon. Have a great day, folks, and I'll see you next time around.